I've analyzed hundreds of rental properties, and I can tell you this. Not all cash-flowing properties are good investments. In fact, some of the worst deals I've ever seen were generating monthly income, but still left their owners broke, stressed, and stuck. So today I'm walking you through 10 signs that a rental property is a bad investment, even if it looks good on paper. Whether you're just starting out or already have a few doors, these are the red flags that will save you from making a six-figure mistake. Let's jump in. Sign number one, the cap rate is below the interest rate. If you're earning a 5% cap rate, but your loan costs 7%, you're losing money on every dollar of borrowed capital. This is what investors call negative leverage. And in today's market, where the 28-day T-bill pays 4.05%, your real estate investment has to beat that baseline. Otherwise, you're better off parking your money risk-free. So if the cap rate doesn't clear the hurdle rate of debt and inflation, that's a bad investment. Sign number two, pro forma rents are used to justify the deal. If the seller or agent says, the rents are $1,200 now, but they could be $1,800 with a little work. Stop right there. Ask, why haven't they already raised them? If raising rents were so easy, the seller would have done it already. Base your analysis on actual in-place rents. Pro forma numbers are fantasies. You need reality. Sign number three, high deferred maintenance or capital expenditures needed. Old roof, aging HVAC, rotting windows, electrical from the 1960s. If you walk through a property and feel like everything needs to be replaced in the next 5 years, you're looking at tens of thousands in hidden costs. Even if the property cash flows on paper, those CapEx expenses will eat your return alive. Sign number four, the tenant base is unstable. Late rent, evictions, cash payments only. No leases on file, or worse, Section 8 with violations already on record. Remember, the quality of your property is directly tied to the quality of your tenants. If tenant behavior is sketchy, inconsistent, or uncooperative, run. Because problem tenants cost you time, money, and stress. Sign number five, rent control laws limit your upside. In markets like California or New York, even if you find a great deal, your hands may be tied when it comes to raising rents, removing non-paying tenants, or improving NOI. If you're buying in a rent-controlled region, your purchase cap rate must be higher, often 7, 8, or even 9%, to offset the lack of future growth. You can't pay for upside you're legally not allowed to realize. Sign number six, overly optimistic appreciation assumptions. You might hear this pitch. This area is gentrifying. In 5 years, it'll double in value. That's speculation, not investing. If the only way the deal works is through future appreciation, you're gambling, not investing. Solid deals make money now, not someday. Sign number seven, your property manager or agent seems too chill about the deal. Misaligned incentives are everywhere in real estate. Your agent wants a commission. Your property manager wants the unit filled fast, not necessarily with the best tenant. Your lender wants to close the loan. You need to ask the hard questions, get second opinions. And remember, no one cares about your money like you do. If a red flag pops up and they say, don't worry about it, that's your signal to dig deeper. Sign number eight, poor location fundamentals. I'm not just talking about crime or school ratings. I'm talking about job growth, population trends, rental demand, and development plans. Even a nice property can be a bad investment if it's in an area where demand is declining. Look up the zip code's demographics. Talk to local landlords. Study the last 5 years of property tax assessments. If the area is shrinking or stagnating, your future returns are at risk. Sign number nine, the numbers only work with 100% occupancy and zero repairs. If your spreadsheet assumes you'll always have tenants, no one will ever break a lease. Nothing will ever leak, break, or need paint. You're not analyzing a deal. You're writing a fairy tale. Every deal should include a 5% vacancy buffer, a 10% maintenance reserve, and enough margin to handle surprises. Because in real estate, surprises are the rule, not the exception. And finally, sign number 10, you don't have a clear exit strategy. How long will you hold the property? Will you refinance? Sell? Do a 1031 exchange? Is this a cash flow play, a flip, or part of your long-term wealth plan? If you can't answer those questions, you're buying blind. Every great investor begins with the end in mind. Know your why, know your timeline, know your goals. Otherwise, you're just another buyer hoping for the best. Now let me leave you with this bonus insight. Bad investments often look like good deals at first glance. That's why it's so important to analyze every rental property through a disciplined underwriting lens. Compare cap rate to interest rate, verify all financials, you vet the tenants in the neighborhood, challenge your assumptions. And remember, a deal that doesn't work on paper will definitely not work in real life. If you want my full rental property analyzer, the exact spreadsheet I use for every deal, check the link in the description. It's free, it's detailed, and it'll save you from making six-figure mistakes. Drop a comment. Which one of these 10 signs have you seen in the wild? And if you're serious about becoming a confident real estate investor, hit subscribe and stick around. We break down deals like this every single week. Let's keep building wealth the smart way, one door at a time. 1.